Hello students, welcome to Accounting Explained at AccountWise Academy. This is Latha Venkateshwaran. Dear students, today let us learn about one of the important topics in marginal costing, contribution and PV ratio, which is an essential topic for your exam. Students, first let us learn about marginal costing. Okay, then we will concentrate on contribution and PV ratio in depth. Marginal costing is a cost accounting technique that focuses only on variable cost incurred in producing additional units. So, marginal costing can be called as a special cost accounting technique where we only consider variable costs for each unit we produce. Okay, so see the name itself is variable cost. It's going to vary according to the number of units we produce. If you're going to produce more units, then the variable cost is going to be more. If you're going to produce lesser units, it's going to be lesser. And if you're going to produce 0 units, variable cost is going to be 0. So it is directly connected to the number of units we produce. Next, coming to fixed cost. Fixed costs are also treated as period cost. Examples, rent and salaries. Rent and salaries we pay periodically, no, only like every month. And the amount is also fixed and it will not change too often. That is why fixed costs are also called as period cost and are not included in the product cost while calculating the product cost using marginal costing. Okay, then marginal costing helps managers make pricing, production, and profitability decisions by analyzing how costs change with production volume. Okay, so it helps the management to make smarter decisions about pricing, output level, that is the production, and profitability because we can see exactly however variable cost and profits change as we produce and sell more units. Okay, marginal costing can also be called as variable costing. Because we consider only variable cost, marginal costing can be called as variable costing. And it provides clear insight into how much each additional unit affects overall cost and profit. Even if you want to produce 1 unit more, you can easily calculate using marginal costing how much it is going to affect our cost and profit. So it also applies for lesser units also. So in this way, you can make analysis very easily using marginal costing. Okay, so you can say marginal costing is a very important or key method where you can use it for real world business choice and also for your exam problems. Now we are going to learn in depth about variable and fixed cost. Variable cost increases with every unit produced. So we can understand this with the graph. Okay, so here in the graph we have blue line as variable cost and orange line as fixed cost. Okay, and in the x-axis you have units, y-axis you have cost in thousands. See, the variable cost line goes slanting from here to here, it rises. Okay, as a if you see here, as the units increases, your variable cost is also increasing. So blue line is your variable cost, as I have already told you. Okay, see, when you produce 0 units, your variable cost is 0. When you produce 50 units, your variable cost is 20. When you produce 100 units, it is 40. When you produce 150 units, it is 60. When you produce 200 units, it is 80. 250 units, it is 100. And like that, it is increasing. Okay, as the units increases, the variable cost increases, or in other words, when the units decrease also, the variable cost decreases. And now, fixed cost. Fixed cost stays the same whether 0 units or 100 units produced. So see the orange line here. It is same one horizontal line starts here and goes straight to the, when compared to the number of units, it is constant. Okay, so when the units are 0, your variable cost is 50k. I mean, sorry, your fixed cost is 50k. 50 units also the same thing. 100 units also the same thing. 150 units also the same thing. 200 same 50k. 250 also 50k. So it remains constant and it is not dependent on the number of units produced. Now let us see the difference between the variable cost and the fixed cost in a tabular column. Again and again I am explaining to you about the difference between the variable cost and fixed cost because it is very important for marginal costing. Unless you are thorough with variable cost and fixed cost, you will not be able to do any sum in the marginal costing. Okay, so stay with me and understand the concepts. First, see in the tabular column, when the units are 0, variable cost is 0, fixed cost is 10,000, your total cost remains 10,000. But when the units increase to 400, variable cost has increased to 8,000. Fixed cost remains the same irrespective of the units, right? So it remains 10,000. Your total cost now becomes 18,000. Like that, for each unit additionally produced, variable cost will also increase. Okay, that part is clear, right? Now, dear students, I want to tell you one thing. If you are finding this lesson helpful, please take a moment to subscribe to the channel and give this video a like and share it with your friends. Your support really will help me to grow and bring you even more valuable exam guidance. Thank you very much. Now let us see what is contribution. Okay, the contribution is the amount from sales left over after covering variable costs. Okay, so it is the amount left over from the sales after covering variable cost. So if you want to write it in the formula, you can write it as contribution is equal to sales minus variable cost. So it is the amount left over after covering the variable cost from sales. Okay, so if you want to find it out per unit, then contribution per unit is equal to selling price per unit minus variable cost per unit. So till here you're clear, no? Next, what for contribution is used? It is helpful for paying off the fixed cost and generate profit. So first it will pay off your fixed cost, and if there is any remaining amount, then that amount will be your profit. So contribution can also be written as fixed cost plus profit. Okay, first there are two things. Each sale is broken into variable cost and contribution. So in other words you can write no sales is equal to contribution plus variable cost. This is one formula. So you can just mix and match. They will ask in any way in the exam. Okay. So each sale is broken into variable cost and contribution. And again, what does this contribution constitute of? It consists of fixed cost, and the remaining amount after covering the fixed cost will be your profit. Dear students, now let us see one example. They have given a selling price per unit as 60, variable cost per unit as 35. Now you have to find out contribution per unit. Contribution, if you want to find it out in total, it is sales minus variable cost, or if you want to find it out per unit, then it is selling price per unit minus variable cost per unit. Here the selling price is 60, variable cost is 35, so contribution per unit will be 25. So contribution per unit is 25. Here you have sold 100 units. So total contribution is 25 into 100, which is equal to 2500. 2500. If fixed cost is 2000, what is the profit? We know contribution consists of both fixed cost and profit. So contribution 2500 is equal to 2000 plus what will be the profit? 500 remaining amount. Okay. So you have to remember contribution is always calculated as selling price minus variable cost. Total contribution tells you how much you have to or you can allocate to fixed cost, and after that only it will cover the profit. Here what did we see? First this 2500 covered the fixed cost, then only we found out the profit. So no matter how big or small the contribution per unit may seem, first it will cover the fixed cost, then it will tell us how much we have got as the profit. I would ask you to practice with different numbers to gain more speed and accuracy for the exam. Okay. We are going to see some common exam mistakes which you will make while calculating contribution and tips for avoiding those mistakes. Mistaking total sales for contribution. You have to remember that total sales is not contribution. Contribution is equal to sales minus variable cost. Meaning contribution is part of sales, it is not sales. Okay. Confusing per unit and total in formulas. If they have asked separately per unit, then calculate per unit, or if they have asked for total contribution, calculate total contribution. Okay. Missing a variable cost component. Sometimes you may confuse a variable cost as a fixed cost. For example, material. Material is a variable cost. Labor, variable overhead, all these costs may be mistaken as a fixed cost. Another important thing is you have to remember contribution is not profit until fixed costs are covered. So contribution is equal to fixed cost plus profit. Unless you take out fixed cost from the contribution, you will not able to find out the profit. Okay. Dear students, these are all the mistakes I have seen as a teacher. You should not make these mistakes. That is why I have given this separately. Okay. And please remember that you have to box your formulas while doing your answer sheet. And you have to double check your inputs before calculation. We are going to see PV ratio or profit volume ratio. PV ratio is equal to contribution divided by sales into 100. PV ratio is represented as a percentage. Okay. Measures the percentage of sales, that is contribution. So it measures a percentage of sales to contribution. Okay. The higher your PV ratio, the more efficiently sales convert to profit. So the more the PV ratio, the more will be the profit. Okay. Now you have to remember that PV ratio helps to compare how each product or sales increases the profitability. Let us understand about PV ratio with a pie diagram. Here, this is a pie diagram of a company which manufactures two products. Blue color is product A and orange color is product B. Here, product A gives you a PV ratio of 61.5% and product B gives a PV ratio of 38.5%. So it means product A gives you more profit. As I have already told you, more the PV ratio, more the profit, right? So the PV ratio tells you what part of every rupee you sell goes straight to profit targets. So it is related to the sales. Okay. The higher the number, the better for your business. The higher the PV ratio, it's better for your business. Okay. Now let us see the importance of PV ratio. Why PV ratio is used by the businesses? Okay, because it compares which products are more profitable. Like in the previous pie chart, we saw two products, BA and B. A had a PV ratio of 68.5%, whereas B had a PV ratio of 31.5%. Like that, we can make comparison. Evaluate the impact of pricing or cost changes on profitability. So you can evaluate the impact of pricing, whether if the price increases or decreases or cost changes. Same thing, increases or decreases on the PV ratio. Make decisions about what to sell or discontinue. So based on the PV ratio, you can decide what to sell or whether to sell that product or to discontinue the product. So with PV ratios, we can find out the product which is the most profitable and adapt quickly if costs or prices changes. Okay. So if a product has high PV ratio, then focus on that product for maximum results. We are going to solve a question for finding out the PV ratio and find out among two products which is more profitable. Okay, so here they have given two products, product A and product B, and they have given per unit price for sales and variable cost. So selling price per unit is 60, variable cost per unit is 35. Similarly, product B, 60 rupees per unit is sales and variable cost is 45 rupees per unit. So I have made a table for finding out the PV ratio. Product A is having a selling price of 60, variable cost of 35. So contribution formula is selling price minus variable cost, which comes to 25. Similarly, product B has a selling price of 60 and variable cost per unit of 45. We have a contribution of selling price minus variable cost is 15. Now we have to find out the PV ratio. As I have told you, PV ratio will always be in percentage. Okay, PV ratio is equal to contribution by sales into 100. Here contribution is 25 divided by 60 into 100 gives you 41.7%. For product B, contribution is 15 divided by sales is 60 into 100 is 25%. Okay, so on seeing, we find out that product A gives you more contribution and a higher PV ratio. So it is a better option for profit. So please always check both contribution and PV ratio before making any recommendations, whether it is for business or for exams. We are going to have a quick recap of the formulas we have learned today. First, we saw contribution is equal to sales minus variable cost. Next, contribution first covers the fixed cost and then it gives us a profit. So, contribution can be written as fixed cost plus profit. Next comes the profit volume ratio or PV ratio, and it is always represented as a percentage. So, contribution divided by sales into 100 is your PV ratio. Let's see one practice question. A company sells product C at rupees 120 per unit with a variable cost of rupees 90 per unit. They sell 80 units. Find what is the contribution per unit, What is the total contribution? If the sales and contribution are as given, what is the PV ratio? Dear students, try this now. I will reveal the answer soon. Thank you, dear students. Next time we will see with advanced practice to master the toughest exam questions. Please subscribe so you never miss an answer. If you would like to inquire about the online classes which I take or to get more worksheets, you can contact us at acc.wiseacademy@gmail.com.